Foundation. We are extremely pleased to have the speakers that we have today lined up to talk about a subject that has probably been first and foremost in everybody's mind. I'm Heidi Kribo-Redeker. I'm the co-director of the Global Strategic Finance Initiative, an initiative that looks at how finance strategically impacts the U.S. We are very pleased today to have Leo Tilman, who is the author of Financial Darwinism. He will be speaking today for about 20 to 30 minutes about his book and some of the policy implications for his theory of the evolution of financial institutions. And then we have commenting and discussing those remarks Tom Gallagher, who's Senior Managing Director of the ISI group here in Washington, D.C. And to kick off, our CEO of the New America Foundation, Steve Cole, Pulitzer Prize-winning author. And I will hand it over to Steve to kick off our discussion today. We'll follow up after Tom's remarks with some Q&A that I'll be kicking off. And thank you again for joining us.
Thank you, Heidi, and good afternoon. Welcome, everybody. My name is Steve Cole. As Heidi says, I'm the president of the New America Foundation. I thought I would just take a minute to put today's program into context here at New America. For those of you who are not familiar with us, we're a think tank that's been around for about 10 years. We have about 100 folks based here in Washington, New York, and in California. We work across a range of policy subjects, both in domestic and economic policy as well as foreign policy. But over the last few months, we have really made an institutional effort to try to concentrate on the economic crisis and on new ways of thinking about the economic and financial regulatory architecture that this crisis has implicated. You know, obviously, an economic crisis of this dimension is a terrible thing. It's also a terrible thing to waste. And one of our propositions over the next few months is to try to think about framings as well as specific policies that might allow the next government, the Obama administration, to seize the opportunity presented by this crisis to deliver a truly transformational result coming out of the recovery. And I think today we're going to begin some of that discourse with Leo Tilman, who is thinking in new ways and radical ways about the architecture that was implicated and in some respects destroyed by these events over the last few months. In the paper this morning, many of you will have noticed the chairman of the Securities and Exchange Commission referring to what appears to be one of the largest Ponzi schemes ever to ride through Wall Street undetected, saying that the Securities and Exchange Commission had early and credible evidence of abuses but had failed to investigate them. And I'm sure that Leo will help us think about not just the conceptual approaches of the government towards Wall Street as it changes and as it rewrites its own business in the aftermath of the crisis, but also the capacity of the government. What is it reasonable to expect our government to do without either setting the bar too low or too high? I think that's not a left question or a right question. It's just I think it's the smart question to be working on as we think through these reforms. Anyway, I can't think of anyone better or better qualified to start us along this path than our speaker today, Leo Tilman. His book, Financial Darwinism, is an important contribution already, and it reflects his prescience about many of the forces that created the crisis in the second half of this year. He is the president of L.M. Tilman and Company, a strategic advisory firm that serves governments, financial institutions, corporations, and institutional investors around the world. Prior to founding this firm, he had senior positions at BlackRock and Bear Stearns, where he was Chief Institutional Strategist and Senior Managing Director, so he wears his ideas on his sleeve and has been involved in many of the institutions whose innovations and practices have given rise to so much discussion over the last 6 months. He now teaches finance at Columbia University, where he was a student both as an undergraduate and a graduate student. and he's the co-author of The Risk Paradigm, which is forthcoming from Oxford University Press next year, and Risk Management, and other journals and books that he has edited and assembled. So please welcome Leo Tilman to the microphone.
Good afternoon. It's a great pleasure to be here. I sincerely thank the New America Foundation for this invitation and opportunity to share these ideas with all of you. And Steve, Heidi, and Tom, thank you for taking the time to be here. When I think of this crisis, it's interesting that the word puzzle comes to mind, because we're trying to put together this extremely complex, multidimensional picture of how different forces and different players have interacted for a long time and have resulted in such a profound worldwide transformation. But this discourse did not start with the fall of Lehman Brothers. Many of us have debated the environment that has shaped this crisis for quite some time, and we were not alone. Early in this decade, Alan Greenspan called the low return environment a conundrum, because they couldn't understand how is it possible that through a convolution of global forces, interest rates were not moving as they normally did. And then, years later, the New York Times summarized it all by saying, market players seem truly horrified because they've realized they don't understand the complex financial system they've created. As I was advising financial institutions throughout, it was that duality, the duality of that environment that was so puzzling. Because on the one hand, we saw record profits, we saw tranquility, global expansion, globalization truly at its best. But at the same time in and time out, you would hear that basic financial businesses are under pressure and nobody can figure out how is it possible that simultaneously you will have these pressures building and at the same time you would have record profits. So what we ended up realizing that we were dealing with the descriptions of this problem using interesting different languages. One of these languages was the language of macroeconomics, where we're talking about building imbalances, low return environment, the role of the Fed, things of that kind. At the same time, we were talking the language of financial instruments and how CDOs were rising and subprime mortgages were rising, etc. Then we were talking about financial institutions themselves and the role of hedge funds, the role of investment banks, sovereign wealth funds, and so on and so forth. And last but not least, the language of that debate was framed as accounting earnings, credit ratings, and standard financial disclosures. And guess what? When we try to put this all together, we can't. And we can't for one reason. The reason is that the crux of the problem lies in the risks that financial institutions take, the risks that are embedded in financial instruments. But none of these languages reveal the risks. So we're trying to get to the description of the problem using a deficient lens. And because of that, we can't quite filter the complexity and we can't quite get to the bottom of it. So what financial Darwinism does, it tries to bring the language of risk and the language of risk management into the discussion that is currently done using completely different languages, because that discussion is absolutely vital if we were to redefine financial institutions, redefine the future of regulation, and link it to the public policy and to economic policy. It all starts with the Great Moderation, and the Great Moderation is a time period coined by Bernanke and others that describes the period from the mid-'80s to today when volatility of everything has declined. Volatility of employment, volatility of GDP, volatility of interest rates. It's that period of tranquility that has really shaped the current environment. But from my perspective, it's not just the description of the macroeconomic environment. It's a description of an evolutionary catalyst that had a lot of different forces come to the forefront and change the financial landscape. Some of these forces were secular in nature. They were things like globalization, disintermediation, the internet, emergence of alternative investments like hedge funds, as well as advances in analytics and technology that allowed very precise dimensions of risk to be isolated and traded and disseminated all around the world. All of these forces are going to be with us for quite some time. And from that perspective, the future environment is going to be very much like the previous environment. The second set of forces was period-specific. We don't quite know how long they will last, but they certainly have affected what has happened on multiple levels. And those forces were the Bretton Woods II currency regime that led to the imbalances in foreign exchange reserve accumulation that amplified this crisis in many ways. And then we had certain cyclical factors. So the Great Moderation, in addition to being a macroeconomic period, in my mind, was the evolutionary catalyst. And the word evolutionary catalyst was mentioned by Neil Ferguson when referring to the Great Depression and the Great Inflation of the 70s, because from his perspective, he compared those periods with asteroid strikes or ice ages that fundamentally changed the financial landscape. When financial Darwinism emerged as a framework several years ago, I truly believed that the Great Moderation is just as powerful of an evolutionary catalyst, but it was difficult to see how it's going to play out. Is it going to be an ice age, or is it going to be an asteroid strike? So from the perspective of financial Darwinism, as we bring in the language of risk into this discussion, we essentially decompose financial institutions into these interesting building blocks. So we no longer care that they have certain lines of business or certain lines on an income statement. All we care about is what kind of risks they take to make money and why. And from that perspective, there are not too many conceptually different ways to make money. And one of them is funding advantages, and funding advantages of government-sponsored enterprises like Fannie Mae and Freddie Mac, or commercial banks, where what they can borrow due to their charter is cheaper than what they can get elsewhere. So that's a very important component of economic performance. And due to all of these secular forces, that component has declined and put pressures on financial institutions. At the same time, fees declined across the board. Brokerage fees, investment banking fees, money management fees, you name it. All of these fees have declined due to transparency, due to the internet, due to global competition. So by the time we got to 2003, that is typically referred to as the origin of this crisis, with the Fed being blamed for flooding the economy with money and exacerbating the housing bubble. All of these pressures have been building for 20 years. And they were due to secular forces, forces that are here to stay. So the premise of the book is that a lot of financial institutions failed to recognize the fundamental change. And when faced with these pressures, they responded by taking on more leverage and risk. And essentially, they started investing in more complex products. They started taking on more liquidity and funding risks, but first and foremost, they engaged in this vicious circle where the more risks they took, the more they compressed the returns, which forced them to lever up even more. And again, impossible to see that unless you translate the language that we typically speak, the language of earnings and macroeconomics, into the language of risk, to show that this environment where everybody was leveraging up was not just a cyclical phenomenon that we always talk about. It's not just an end of an economic expansion exacerbated by securitization. It's truly a response to long-term building pressures. And financial institutions in many ways exacerbated that. Once it gets going the other way, what we have seen is very much the same as we have seen during the previous crises, particularly the 1998 LTCM crisis. It all starts with some kind of exogenous catalyst. In this particular case, it was housing. In 1998, it was Russia's default. And once it gets going, you start with risk aversion and deleveraging, and then all financial markets become illiquid. Then you have margin calls and forced liquidations. And then you have contagion into other asset classes. Here goes the theory of emerging markets now being decoupled from the rest. And there's the inability to borrow, and it goes on and on and on. So this is verbatim what happened in 1998 as well. Now we're observing exactly the same, only on a different scale. And what makes this crisis particularly difficult is that in addition to this vicious circle that spans capital markets and financial institutions, you also have the housing market and the real economy participating and exacerbating this vicious circle. So the way to think about the bailout, the way to think about the actions by the Federal Reserve, both in terms of the monetary policy as well as funding facilities, is attempts to break this vicious circle in very particular places. And you need a combination of measures to do that. And the only part that is truly missing is the original TARP intent to buy distressed assets, because it would have completed the arsenal of tools needed. The abandonment of it certainly makes it more difficult to break this vicious circle. And today's papers reported that the new administration is exploring ways to bring that component of the bailout back. So, so far, I've been talking in fairly general terms. So let me illuminate some of what I was talking about using more technical and rigorous ways. So think of your favorite financial institution, and I presented it as a dinosaur for obvious reasons. And the reason why it's important is because your interpretation of what happened and your interpretation of who is to blame will directly correspond to the regulatory actions and public policy actions. So understanding the origins of this crisis, in my mind, is absolutely necessary. And if your view is, here's the financial institution, should have been perfectly happy because there is plenty of money to go around, and then something unexplainable happens, and greed takes over, and these financial institutions start to reach for more and more leverage and risk. Needless to say, the moment there is a gust of wind, they fall down. They need to be bailed out by a whole bunch of innocent bystanders. If that's the interpretation, then it's absolutely clear what you should be doing. You should embark on protectionism to protect these institutions from future competition. You need to embark on overregulation because you need to prevent them from engaging in certain activities like building ladders and leveraging up more. And for good measure, you should also limit the executive compensation. So the current discourse on the crisis, which is all about greed on Wall Street and lack of oversight and regulation, lends itself onto very specific public policy and regulatory actions. Let me tell you what my interpretation of this crisis would be. Pressures have been building for quite some time. Financial institutions need to deliver returns irrespective of the market environment. That's what credit rating agencies want. That's what equity analysts want. That's what investors want. So, unfortunately, financial institutions are limited in the way they also think about the world, and their strategic vision is very constrained and shaped by the past 20 years of the same kind of direction. So the only thing that they can think of how to respond to these pressures is to start to reach for more earnings and more leverage. And they're doing it out of necessity rather than greed. And their behavior is shaped by a lot of external forces and the internal ways of thinking about it. As they're reaching for leverage and risk because they're failing to recognize the change and evolve, what they're not seeing is that the ice age is coming because they're so focused on risk and leverage. And of course, they don't get just knocked down, they get extinct. And instead of building ladders and reaching for leverage, they should have thought about other ways of delivering returns, and hence the reference to the best-selling book, Blue Ocean Strategy. So, as Steve mentioned, this crisis is a unique opportunity on so many different levels. But we need to redesign the way we think about this, and we need to change the language, because the language that we speak about this crisis and about financial institutions is simply incapable of describing the causes and remedies of what just happened. One direction is to redesign financial institutions, to crystallize their business models, to redefine the role that risk-taking plays in these business models, and redefine the strategic vision of financial executives of how you create real and lasting economic value in finance. It's a uphill battle, but I think companies that will survive will have to embark on this path. Another one is the risk-based transparency. And I didn't say risk-based regulation, I said risk-based transparency. Because first and foremost, we need to describe how financial institutions create value and what risks they take in the process. As a matter of fact, if I were to trade with a financial institution or invest in a financial institution or regulate it, all I need to know are these two things. One, out of the economic earnings that you make, what is the breakdown? How much do you make from fees? How much do you make from customer activities? How much do you make from risks, and which kinds of risks? And two, how much total risk do you take in the process? If I know the answers to these two questions, I'll know everything there is to know about how to regulate these institutions, how to value them, what kind of PE ratios to assign to them, and so on and so forth. So that to me is a necessary step under any circumstances. From that, you can go in two different directions. You can try to regulate these financial institutions based on that information, or you can empower capital markets to see this information and force behaviors externally. Because if capital markets saw the build-up in leverage, and they truly saw what financial institutions were doing during this time, PE ratios would have declined, credit spreads would have increased, and that behavior would have been regulated by the capital markets rather than regulators. So to Steve's point, how much of it can we rely on in terms of regulation? I think it should be a combination, but the most effective regulator will be capital markets empowered by the right information. And a lot of this is done to preserve what Nobel Prize laureate Ned Phelps, who wrote the foreword to Darwinism, calls economic dynamism. And economic dynamism is a system that facilitates discovery, financing, and development of viable innovations. That's what we want, right? We want a system where capital flows freely to where it's most needed to develop these viable innovations. And Professor Phelps claims that capitalism remains that system, even though it's been disgraced in its area of most competence, as shown by this crisis. So preserving economic dynamism in everything that we do, to me, is a huge priority. And last but not least, it's economic policy, because the vision of financial institutions on what they should look like, which risks they should take, which businesses they should engage in, is not formulated in an analytical vacuum. It's shaped by the direction of the economy. We had the economy throughout the Great Moderation that was moving toward consumer-based economy, where everybody else was there to facilitate consumer spending. And we facilitated it by enabling consumers to tap into their home equities, as well as to gain cheap access to capital markets. And that's what Wall Street was doing. Wall Street was a consequence of that direction. So now, as we're redefining the economic policy, and we're thinking about infrastructure rebuilding, we're thinking about new industries, each one of these decisions in many ways will impact the Wall Street, will impact the business models. So all of this can be done together. So needless to say, it's been extremely exciting analytical journey trying to redefine these languages and trying to incorporate this into real life decisions by very large financial institutions. And I'm hoping that we use this opportunity as a is an attempt to redesign financial institutions, empower regulation, preserve economic dynamism, and link it to viable economic policy. So thank you so much for your attention. I really appreciate it, and look forward to your questions and comments, and certainly to Tom's remarks as well.
Leo, thank you so much. That's you have a tremendous platform from which to speak. There was a lot of very important and I think very very good material to base a very constructive conversation about where we go from here, as opposed to just pointing fingers and assigning blame. So with that, I am very happy to introduce Tom Gallagher to come and comment on Leo's discussion today, and after that we'll open it up to questions and answers from you.
Thanks, Heidi. It's nice to join you and Leo on the panel today. I guess I have to. It's hard to resist the obvious line here that I think Leo's presentation goes to show that the structure of financial markets the last several years is much more evidence of the theory of evolution than it is of intelligent design. What I want to do in just some brief remarks is make 3 points. The first really is a question to Leo based on what he said and what's in his book. It can answer, maybe I'll pose the first question. And that is that I know your book was designed as much for business managers, the people who run the companies, as it is for policymakers. And what it calls to mind is what I'm sure is going to be a signature line of the episode we just went through, the famous line from Chuck Prince, the Prince formerly known as CEO of Citigroup, who said that when the music stops, there'll be trouble, but as long as the music is playing, we've got to get up and dance, and we're still dancing. And I guess my question to you, Leo, is there a way in the last several years that the head of a bank, of a mortgage lender, of just anybody in that part of the business could have resisted this? Are there examples of companies that that did so? Or if you were on the corporate board for one of these banks, how would you have resisted the pressure to pay your CEOs an exorbitant amount, or how would you have resisted the pressure to make these kinds of loans? And if you couldn't, if that's the answer, then I guess it really does come back to a policy question. If we're going to confront periods of excess leverage like this, that ultimately comes back to a policy question. So I look forward to your observations on that. A second point is that I think this is a time where policymakers really have to resist the urge to overregulate. In some ways, that's kind of a throwaway line. Maybe it's just an easy thing to say because nobody's really out there, in favor of overregulation. So I recognize that's not a very helpful line, but at times like now in a financial crisis, it strikes me that so much of the political narrative is a morality tale rather than an economic tale. That is, it's so much easier to oppose a bailout because you're helping people who don't deserve to be bailed out, you're bailing people out of bad decisions, rather than to think about it more in economic terms. I mean, the morality tale is easier; it's kind of a binary question, and the economic challenge is a more difficult one. But I suspect that the political reaction to what's going on is going to be shaped by recent news events. The scandal, the Madoff scandal. I mean, a name right out of a Dickens novel, right? Made off with your money. I mean, so it's going to be perceived as more of a morality tale, and I think there's going to be a temptation to overregulate, to prescribe more of what the structure of financial markets would look like. And I think Leo's comments, I think, are a useful framework for thinking about how to avoid the overregulation, to capture the dynamics of capital markets without depriving us of that. Another good book on financial issues lately, Niall Ferguson, whom Leo quoted, wrote a book on the ascent of money, and he starts off right at the beginning saying that money may be the root of all evil, but it's also the root of all progress. And I think you don't want to go too far in in the other direction in terms of regulating, or at least to find the right way to regulate executive compensation. I don't think you want to overburden banks as they're trying to get out from under a real mess with further responsibilities that might serve other political agendas. So that's the second point. The third point is to put financial re-regulation into the context of where we are now. And that is, I think that re-regulating the financial sector, the financial markets, is really more of a medium-term objective. That is the immediate objective. The short-term objective is really to deal with the economic impact of the financial crisis. It's just kind of that basic observation. At first you put the fire out, and then you worry about rebuilding a fireproof house. And I think that this is, in some ways, it's hard to appreciate just how bad the economic situation is. I mean, you look at the data from yesterday. Housing starts were came in well below expectations. I think it was 635,000, 625,000. The lowest that you'd ever seen in a business cycle for the last few decades was right around 800,000, just below 800,000. I mean, it was significantly weaker than expected. The CPI came out yesterday showing month-over-month deflation. If the CPI next month is another -1% at an annualized basis, this quarter will be the biggest deflationary quarter in U.S. history. I mean, including the 1930s. Now, I know that's very much driven by oil, but if you look at core inflation in the last 3 months, it's been flat as well. So it's a risk. It's not necessarily the baseline scenario, but it's a risk. And so I would just offer a few thoughts on the near-term agenda, the near-term policy response to the financial crisis, maybe a list of things that you would be looking for from the Obama administration. The first is, in terms of fiscal stimulus, I think it has to be bigger and quicker than most people are talking about now. That is, bigger just in terms of exceeding expectations, earlier in the sense that I think that most of Washington knows you had to have a big 2009 stimulus. I think there's less appreciation that there has to be a big early 2009 stimulus, faster than rebate checks would provide, certainly faster than infrastructure spending would provide. I think a second feature is and what I think will be the biggest difference between the Bush administration and the Obama administration is using taxpayer money to support the housing sector. This is a tricky issue because you've got to make a distinction between trying to sustain what are still probably unsustainable housing prices. You don't want to do that, but more, I think you want to try to cushion the decline. You want to prevent an overshoot in home prices, and there's a lot of talk about that. But I think there's a potential for a significant impact both for the housing sector, but then even indirectly for the banking sector by lifting the price of some of these assets. And I think there are ways you can do this on both the demand side and the supply side for the housing market. But then finally, just the last point on what the optimal policy mix is here is I think it's important to improve on the bank rescue operation. That in a way that's easy to overlook because it's extremely technical, and I don't pretend to, well, maybe I do pretend, but I don't really understand the details of it that well. But when you look at Japan, Japan, they started late, but they had as aggressive monetary and fiscal stimulus as the U.S. is looking at, and it didn't really work. And the key reason, I think, is because they didn't have a good bank rescue, or they didn't have an adequate way to address the problem of the assets on bank balance sheets. And so I think that there's some ways to improve on that, lessons to learn from how the Swedish government dealt with this. But I also think it probably requires a bigger TARP. And so I think that's a challenging part of the economic package that the Obama administration has to do, is to come up with a way to create better incentives for banks to make loans, and it's probably going to require an even bigger TARP as well. So those are my comments on Leo's paper and comments on the broader situation. I'll turn it over to Heidi.
Tom, thank you. Thank you very, very much. I think there's some very good material to start with here. And the first question has already come from Tom. So I'd like to invite Leo to come up here with me. Leo, CNN called you the man who predicted the current crisis. And you and I had conversations even dating back to 2005 when you were starting to think through how all of the concerns that were raised in your mind were, how they were going to play through. You were speaking with heads of banks and financial institutions, and you yourself were at Bear Stearns. Who listened to you? Who didn't? And I guess this sort of wraps into Tom's question. But if they didn't listen to you, why?
Thank you, Heidi, and thank you, Tom, for your comments. I think the two questions are completely interconnected because they get to the bottom of what were the dimensions of failure to evolve, if you will. And in my experience, there were three different kinds. And again, as we're thinking about regulatory implications, how do we regulate reckless behavior versus how do we regulate natural selection? It's very, very different. The first kind of executives that I have encountered, and many of them are no longer with us, was the complete failure to recognize the change and complete failure to recognize that their companies were under severe pressure due to the change in the macroeconomic environment and this routine-based thinking that our business is fine, our customers are fine, and the natural cycles will bail us out is what got people into trouble. So one is the classic failure to evolve. Another one is what I would call leadership by delusion. And leadership by delusion is actually fundamental misunderstanding of your own institution's business model. It might sound strange to you, but again, if you speak the language of accounting earnings and you spend your days optimizing accounting earnings, talking to regulators, deciding where to build your branches and which institutions to acquire, and you're not watching the kinds of risks that your companies are taking, you yourself may be confused about the business model, and it was not as rare as you think. And some of the mortgage operations that we talked about before, some of the other activities where the proportion of risk taking to the overall bottom line was increasing dramatically over the years, yet executives continued to think that they were in the old business. And of course, that failure to evolve led to tremendous losses, particularly in proprietary trading portfolios and hedge funds and mortgage origination platforms and so on. And the third one is the quote that Tom mentioned, which is, while the music is playing, we have to be dancing, which is the purely constrained vision of what you're here to do as an executive, and the belief that certain risks are in the nature of your institution, and if everybody's taking them, then you have to be taken. And that's a matter of transparency and regulation and improper incentives. But a lot of them, I'm not sure how to quite regulate the first one. If someone is on the path to extinction, and to your point, Heidi, when people are making record profits, they're not as responsive to the conversation and the suggestion that they are on the path to extinction as you might think. But we have encountered quite a number of them. So I'm not sure what to do with that. The second one is a matter of illuminating reality. If these executives saw through more risk-based frameworks the kinds of risks that the institutions were taking, and if boards of directors were also empowered by this kind of information, when they saw that the component of earnings that is now due to risk is gradually increasing over time, they might have gotten uncomfortable. So, and the third one is definitely a matter of lack of risk-based transparency, because as I said, if the build-up in leverage was accompanied by everybody's knowledge that all of these companies were taking on more and more and more risk to deliver the same amount of earnings, then equity valuations would have declined, their borrowing costs would have increased, and markets themselves would have regulated that behavior and forced financial executives to start thinking on what is the value proposition. Where else can I grow my earnings without blindly leveraging up? So I felt that distinguishing between these three cases was informative on my side in terms of advising financial institutions, but also on the regulatory side, because the way you regulate each one of them is very different.
Another question for you. You are very familiar with Fannie Mae and Freddie Mac, and you spent a good part of your book looking at Fannie Mae and Freddie Mac. I don't know if you are a fan. I would assume that you're not a fan of the nationalization, but we are where we are right now. I'd like you to explain why you think the way that the government approached Fannie Mae and Freddie Mac with the nationalization made sense or didn't make sense, and then more importantly, we are where we are. Where do we go from here, both short term and medium term, with the future of the GSEs?
Thank you, Heidi. I think the last question is very difficult to answer because it's probably more a political reality rather than an economic one. Government-sponsored enterprises present an amazingly interesting case in financial Darwinism because they are created, first of all, to be counter-cyclical. They're created to provide the buffer to the economy in times of crisis. They're there to facilitate home ownership, and that's an important component. But the second and less talked about mission of GSEs that is absolutely clearly stated is to stabilize markets in times of crisis. So as markets are falling down, you're supposed to step in and buy. So needless to say, in times of crisis, your capital is at risk. And needless to say, people expect you to start losing money in times of crisis. So I thought it was a given, and yet it became quite a surprise to many that the capital of these companies was declining during this crisis, and they needed restructuring and help, etc. But to me, it was done by design, right? In order to fulfill this dual role of facilitating home ownership and stabilizing markets, that's what you would expect. And the question can be, what is the adequate capital to do that, and so on. So that's one direction. Another direction is, again, government-sponsored enterprises represent a very constrained business model. They have their funding advantages that are due to Treasury guarantees, and then they have their credit business, and then they have their portfolio business. And there are only three sources of revenues, and it's very difficult to diversify these sources of revenue. So in many cases, these companies have been compared to monoline insurers because of the clear nature of their exposures. And of course, the remedies to that would be to think about the charter and think about the strategic vision of these companies to enable them to become more dynamic and diversify that business model. And I guess what happened was one of the testaments that the business model as defined and the dual mission were incompatible. The nationalization, I think, was a problematic solution. You can debate whether it was warranted or not on the institution side. And again, without significant proprietary information, it's impossible to answer this question. But we know what it did to others. It essentially incapacitated preferred shares markets because nobody could raise preferred stock anymore because of that. And secondly, a lot of financial institutions who owned preferred shares of Fannie Mae and Freddie Mac were wiped out. So they had to liquidate assets. They had to raise capital, and that exacerbated the crisis in the prelude to Lehman Brothers. So from that perspective, it certainly was very detrimental to capital markets in the way that it was done because of its ripple effects that happened. So we need to think broadly about GSEs because they play a very important role in the economy, but the way their business models were constructed and the way their missions were defined was just unstable. And therefore, we need to think about what would be the optimal business model of these entities. Is it public? Is it private? How is it done? And how it interacts with these two very critical missions that they have. But in general, this notion of what is a sustainable business model and what is a non-sustainable business model became loud and clear during this time. Tom talked about deregulation or re-regulation. And when people talk about deregulation, they typically refer to the repeal of the Glass-Steagall Act as the key contributor to this crisis. I would propose that it's quite the opposite. As a matter of fact, the ability of investment banks to be merged with commercial banks stabilized their business models. Without that repeal, we would have had many, many more investment banks in trouble as opposed to only 5 of them. And the conversion of Goldman Sachs and Morgan Stanley into bank holding companies is a testament that that business model is much more stable than the business model of an independent investment bank. So now we're seeing both companies embark on specific actions on how to increase that component, which is very much done in the spirit of financial Darwinism.
And I have one more question for you before I open it up to the audience. And that is, you raised in one of your scenarios executive compensation, and in a lot of the policy discussions right now about how do we go forward, the element of how we compensate financial executives it comes up again and again, and I would ask you what your view of what that role of executive compensation, restructuring it, should be, and also, is that missing some of the point that some of the risk takers, some of the incentives and the compensation to the risk takers themselves might get more at the core, sort of the traders that are taking the risk, the incentives they had led to recklessness, and that cannot be denied whether it's within an evolutionary theory or not. What do we do with that part of the puzzle?
Well, it's a very complex question. And again, I go back to my 3 types of leadership. When someone is on the path to extinction, I'm not sure what you can do and how changing executive compensation will change that mentality. With everybody else, the goal of these endeavors, and I think some of the European leaders articulated that, the goal of curbing executive compensation is to limit reckless risk-taking that companies take, right? So the assumption is that financial executives are fully aware of the kinds of risks that they're taking, and they choose to do that because of improper incentives, which is, in the case of while the music is playing, we have to be dancing, is absolutely true. So there, you want to prevent that behavior. But when people are genuinely confused about the nature of their business models, they just don't know, right? So constraining their comp will probably do very little. And again, I go back to the notion of risk-based transparency. Think of how financial executives get compensated. They compensated based on the performance of their stocks, right? So it sort of happened to be the case that during the build-up and leverage, all of these folks were focused on growing book values, which is a meaningless accounting number reported by everyone, and generating stable and growing accounting earnings, which is another meaningless number, in order to create performance. And equity markets were compensating executives for doing just that, right? And the notion of how much risk was taken in the process and how these risks were increasing in magnitude over time was missing. Because if that knowledge was there, these share prices would not have grown, because financial markets would have penalized that behavior by assigning higher risk premium and constraining it. So by definition, the behavior executives would have changed because capital markets would not have rewarded that behavior. So that's why I keep going back to this notion of risk-based transparency and a combination of solutions through regulation, but also solutions through capital markets, because it's a combination of the two that needs to regulate, and providing the right information to very skillful equity analysts would do just that.
And with that, I'd like to open it up to the floor for questions for either Leo or Tom. And I think both of them today have approached this discussion in an extremely constructive way, and I think that due to the seriousness of the topic and wanting to sort of get to a solution, I just wanted to lay the framework in as constructive a manner as possible. And with that, gentleman right back here.
This is a question for Leo. You've taken sort of a complexity science perspective. So my question is, if capital markets are there to sort of finance new sets of technology. So during the internet era, you had different forms of capital financing. So if we've got green technology or new medical devices or sort of new technologies that are needing to be financed, how do you see sort of evolution of new species? Because you mentioned that Goldman and Morgan are now bank holding companies. Where is the new sets of players, species, if you will, of financial institutions being able to finance the next set of growth engines that we need?
Well, I think it'll have to be these major financial conglomerates, because financing of these long-term viable innovations requires an entirely different horizon for your returns, right? It's no longer accumulate mortgages, slice and dice them, sell them all out, collect fees, which can be done in a couple of months, right? And your risk tolerance and your expected returns are shaped by that activity. Now you have to engage in pretty much private equity-like activities, which requires capital, long-term horizons, and diversification on the business level model. So I think large financial conglomerates that will have a stabilized business model through retail funding and retail deposits will have an opportunity to do that in their risk-taking activities. But again, it probably, or hopefully, will be those kinds of activities and those kinds of risks that are taken on balance sheets rather than proprietary trading or hedge funds that have occupied that risk-taking capacity for quite some time.
Gentleman in the back right over there.
Okay, one clarifying question about something you said earlier, and then a follow-up to that idea. First one is, you talked about the combination of the investment and commercial banks being sort of helpful in the crisis in the sense that they have bigger balance sheets, but I thought about AIG and how you have the holding company is bankrupt, but that the individual insurance companies are ring-fenced by regulation. So wouldn't it be the case that if an investment bank side lost a lot of money, they would then be able to raid the deposits of the commercial bank side? That would probably be prohibited by regulation, wouldn't it? So it's more appearance than reality, I would think. So that's the clarifying part. The follow-up is, what about private equity or alternative assets as a model in the new evolution of financial institutions? Because the long-term horizon you mentioned is exactly what private equity does. Now, they're going to be transformed as well because leverage is less than it's been. And also the venture capital, you talk about financing innovation, venture capital is perfectly set up for that. So what about this alternative asset class? How will that change and evolve, and will it grow as a result of the new environment?
Thank you for that. It's obviously pure speculation on my part, but right now we had two specialized industries, venture capital and private equity, doing all of that work, while the main machinery on Wall Street was occupied by slicing and dicing housing and student loans and so on. So what we're saying is that more of mainstream financial institutions get involved in that activity, hopefully providing access to more efficient and cheap financing and better terms and just a better scale of doing that, right? So some of the quotes is that, if I'm not mistaken, it was Deutsche Bank that financed Edison's inventions, right? So we're thinking about the old-fashioned combination of commercial banking and merchant banking combined with modern technology and modern scale in order to do that. And of course, I would venture a guess that the flow of capital and the cost of capital and sophistication can be dramatically increased if not two specialized industries, but everybody is engaged in these activities.
Gentleman right over here.
Thank you. Leo, you used the word risk more than any other word in your presentation, and I want to comment from both you and Tom. Washington's culture, especially at the regulatory level, is not one that values risk. It's a culture of regulation which has as its goal the mitigation of risk. How do you actually see the Washington involvement in the financial sector moving forward with a very risk-averse mentality actually fostering the risk that I believe is the core of your basic thesis for the sector moving forward and evolving?
Thank you. Modern financial technology is so extraordinarily sophisticated. You can take any kind of instrument in any kind of financial institution and slice and dice it in 50 different ways. So I would venture a suggestion that in the modern world, regulating like this is just not possible. Unless you want to prohibit certain activities altogether, you will never be able to specify granularly enough which risks you allow and which risks you don't allow. So I think it's just an impossible proposition to begin with, right? And unfortunately, it's the reality that today you can't quite regulate based on accounting earnings and leverage ratios and all of these constructs that are not reflective of what kind of risks these institutions are taking. So I think there were references by the Federal Reserve to risk-focused regulation and other things, and I think we have to move down this path. This will involve revisiting fair value accounting, because the only way to illuminate this reality is to fair value these holdings, and then you have to meaningfully incorporate it into systemic regulation so that fair value accounting is not exacerbating crises, and there are solutions to that. But first and foremost, you need to illuminate what is going on inside of these institutions and what is going on inside of these instruments, and it's just not possible to do otherwise. So regulation must be based not on charters, because you can have two different banks that are taking exactly opposite kinds of risks and should have different capital requirements and regulators, etc. Because with modern technology, I can take a bank and through derivatives and securitization convert it into an insurance company, and nobody would notice, and vice versa. So regulation must be based not on what someone is called, but on their business model. The riskier the business model, the more capital they need, the more oversight they need. Depending on the business model, you will need different kinds of examiners there, because sometimes you'll need people who are skilled in operational risks, and sometimes you'll need people who specialize in proprietary trading, et cetera, et cetera. So the language of that needs to change, and I realize it's a overwhelming task. But first and foremost, the simple acknowledgement that at the core of all of these issues is risk, and that risk is obscured. So first and foremost, you need to know what that is. And the same applies verbatim on the level of regulation and public policy, but the same applies verbatim inside of financial institutions, whose executives and boards directors, in many cases, don't know what these risks are too. So it would benefit both.
So just a couple thoughts on that. I'm not sure I agree with the premise that the regulatory culture in Washington will suppress risk, or it hadn't over the last several years. Maybe the political layer over the bureaucracy, dictated that outcome. But I do agree that I think that is, that's why I talked about it. I think that's the risk of the next several years, is that, if the political or the regulatory framework in the last several years allowed too much risk taking, then over the next several years it will probably allow too little. I don't know what the structure is going to look like. I know that the committee chairman, I think, have a pretty ambitious agenda on this. I think Senator Dodd has said that he wants to have a bill out of his committee on the regulatory side by April, which would be very ambitious. My guess as to how, I don't know the details on how they're going to do it, but my guess is they'll try to seek, they'll impose higher capital requirements or dictate that regulators produce higher capital requirements in order to reduce leverage among institutions that are now regulated, and then they'll extend the regulatory reach probably to hedge funds and to private equity firms that are now outside that reach. I think as a starting point, that's probably a useful way to think about the direction that this is going to head.
If you allow me to digress for just a minute, obviously overregulation is on the forefront of our discussions right now, but as early as in January of this year at the World Economic Forum in Davos, I've noticed a very interesting shift in the sentiment toward these issues, and they had to do more with globalization and the nature of globalization rather than financial regulation. But essentially, the narrative that Joe Stiglitz has pioneered, that globalization is a natural phenomenon that needs to benefit more people, and has completely been transformed in the course of several days into the notion that globalization is a dangerous phenomenon that needs to be controlled. And it needs to be controlled both in terms of financial markets, but also in terms of building imbalances and what they mean for the balance of power. So it's interesting that the same kind of conversation on a different scale and on a different level has been around for quite some time. And again, it will impact not only financial regulation, but protectionism and other issues.
Great. This gentleman right here in the front.
Charge and freelance correspondent. We talked about this nationalization. Two-May already is semi-nationalized, and now we completely nationalize the bank and the Two-May. But there's no restructure or some other thing going on. How do we make sure there is success? And I think we need to modify the institution. The CEO not just responsible for shareholder. They all need to think about the social responsibility. Thank you.
Thank you for your question. You're pointing a very interesting dichotomy, that during the bailout of the auto industry, people demanded very specific plan to restructure it before providing funds. Yet none of this was evident with financial institutions. And there are two reasons for that. One, I think there was a quick acknowledgement on the part of everybody that financial institutions are now so embedded in the functioning of the real economy and consumers that without bailing them, we're going to have a much worse economic deterioration. So that had to be done under any circumstances and quickly. And that's why way of thinking. And I think the second angle is it's not commonly believed that business models of financial institutions are broken, right? There could have been excesses, improper incentives, but I have tried to argue that they're seriously broken. And without that acknowledgement, you don't demand in exchange for your funds a complete restructuring. And I think it will come down the road as financial executives and others realize that the environment over the next few years is going to be just as difficult and just as challenging as before. As for corporate social responsibility, which I'm a huge fan of in general, and again, it's something that has been discussed in Davos and elsewhere for years. I have always felt that current approaches were somewhat unrealistic because if the behavior of financial executives is driven by capital markets, and capital markets reward the greatest return on equity, it's very difficult to incorporate corporate social responsibility into that thinking. So my hope, and again, it's an area of future research, of taking this framework that shapes executive level strategic vision for companies and incorporating corporate social responsibility in meaningful ways that enable financial executives to articulate to their stakeholders why it's beneficial. Because so far, corporate social responsibility has never been presented in terms of benefits to the stakeholders, and therefore, its impact has been limited.
If I could just add a comment on that, that's the issue you raise. I think is one of the things that I think needs to be addressed in the whole bank rescue operation. I think the critical problem is the uncertain valuation of bank assets. What it causes banks to do is to hoard capital rather than to make loans because they hold on to the money in case they need to have to cover future write-offs, and it makes it harder to attract private capital because they don't know if there are going to be future write-downs that will hurt their position. So one way this was done when Sweden seemed to have had the kind of the best practices model for dealing with banking crises, they had what was called a bad bank, so when a bank was nationalized, the bad bank took the bad assets from the bank, so they had forced a major write-down, and then the banks were privatized again. So you take the assets off the balance sheet of the banks, and the government absorbs the losses, or at least takes risk for losses on that. But then you have a smaller but a more credible balance sheet, so that banks can then start to make loans and to attract private capital. Now, in the U.S., that would be a very expensive proposition. If you look at the Citigroup rescue, the bad assets that were identified on the balance sheet, there were $305 billion. And so it may be more, but that's what was identified here. So that's almost all of the rest of the TARP, right? So I agree with what Leo said in his presentation, that I think going back to the original uses of the TARP is something that will have to be done, but you have to find a way to scale it up. Or maybe a second best approach here is, instead of creating a bad bank, maybe when a bank goes back for a second round of capital, maybe the regulators just compel them to take a bigger write-down, a more aggressive write-down. It's kind of a second best option, because the questionable assets are still on the bank balance sheet, and the management's judgment may still be part of the issue there, but that may be a more, like I say, an acceptable second best option here in the U.S.
Right over here.
Thank you. I want to follow up on the point on TARP, because you both mentioned it in your vicious circle chart, and specifically, what you said could be scope and size going forward. And obviously, we have half a TARP sitting there waiting to be deployed, whether that's big enough and what they're going to do with it. So that kind of question, if you were to sit down with Geithner today, what would your 3 or 4 kind of suggestions be for TARP going forward in the next year or two?
Well, only two come to mind on my side. One, you must ensure that whoever gets TARP money lends, right? Because right now, as Tom mentioned, that money is used as insurance for future losses, and the true benefit to the economy is fairly limited. So ways to ensure that that money is actually used with the multiplier as intended is absolutely critical. And secondly, again, part of the reason for deterioration is the fact that there's no market for these distressed assets and the creation of that market. And I think the Wall Street Journal reported today that Obama's campaign is seriously thinking about the establishment of that market in one shape or form. It's an absolutely critical part, because right now, if you look at valuations of different assets, particularly loans and securities, they're so far below any kind of reasonable estimate of intrinsic value. So the establishment of that market will truly stabilize these prices. And I would venture, as a non-economist, I would venture the following guess. It's been said for a long time that right now, monetary policy in the U.S. does not require a lot of open market operations, because the moment the Fed says we're setting the rate at X, the rate just goes there, because everybody knows that in a self-fulfilling prophecy, if it doesn't, the Fed will ensure that it does. In the same way, I've always thought that TARP could actually stabilize these markets without requiring the government to spend a lot of money on it, because the mere notion that the government is there to provide that bid could stabilize these markets. So the fear that TARP will absorb all of these liquid assets, not stabilize these markets, not use multipliers, and not do its job, to me was always questionable, because I thought that the presence of this market alone could do worlds of wonder to this situation.
Basically 3 things. Find some way to deal with the bad assets, either get them off the bank balance sheets or write them down. Second, make it bigger, which would be really popular. So third, make it more attractive to taxpayers and less attractive to shareholders and management. That is, kind of the first round of capital with more or less for free, minimal cost. Then the second round has to be tougher for shareholders, for the banks that can't survive without another round of capital. Make it tougher on shareholders and tougher on management. And so you can sell it as a better deal for.
Tougher in terms?
Well, like the value of the warrants, that the warrants in the Citigroup deal were quite a bit higher than the prevailing price. I don't know. I think there are various ways. I don't know if you have to fire the management or impose some kind of costs on management. But I think that's the way to try to sell an improved TARP or an improved bank rescue operation is to argue that you'll get better terms for the taxpayer.
Gentleman right here in the back.
Leo, Tom, how bad do you think this could get? Can you address that? I mean, the dollar's weakening now, and do you have a view on what the impact is going to be on our reserve currency long term?
Would you like to take this first?
Sure. I would, if you look at, define how bad it could get, you know, the peak to trough decline in GDP, the depression was something like 27%, okay? Since then, the worst has been, I want to say 3.5 or something like that. And my guess is it'll be less than that, but kind of, you know, toward the high end of that range, you know, the post-depression range, the decline in GDP. And I think a weaker dollar is more or less an inevitable consequence of all the policy actions. I mean, after all, you know, we've got a huge current account deficit. You know, if there's a country that should be having a weaker currency, it's ours. And so I don't necessarily think that's a bad outcome, nor do I think the reserve currency status is in real doubt under a kind of the most plausible range of outcomes. Yes, under a very severe one, but I really do think that the policy response here has been pretty impressive, which makes me want to rule out the more extreme outcomes.
I would agree with that. I don't have a view on the GDP decline, but I think we have in place the number of measures that will start working. Monetary policy, actions to lower long-term rates, funding facilities, the bailout, and actions to stem mortgage foreclosures. So, and hopefully TARP buying will come in one shape or form. So from that viewpoint, hopefully all of this stabilizes the housing sometime next year, and then you have sort of a slow U-shaped recovery for quite some time. The good news is I believe that larger deficits are not going to translate into higher interest rates in any shape or form in any foreseeable future. Given the flight to quality and given the uncertainty elsewhere, dollar as a reserve currency is not a risk in my mind. And another positive thing is inflationary pressures are nowhere near on the horizon in any foreseeable future. So we're not going to need to balance this kind of massive stimulation to the economy with potential for inflation near term. Would you agree with that, Tom?
I would. I absolutely would agree with that. Can I just throw in just one more thought in the whole thing? I think one thing that has to be frustrating from a policymaker point of view here is that the ideal policy mix executed in an optimal way, all it really buys you is a less severe recession and a less bad bear market, because the deleveraging that was at the core of Leo's description of what what we're going through now, it means that you can't sustain what were unsustainable home prices or consumption levels that were driven by those home prices, and so those have to come down. And so the payoff for superb policy making here is still a pretty negative economic outlook for say the next 12 to 24 months.
The question right over here.
Thank you. My daughter works for Equity Exotics and Risk Analysis Unit of JP Morgan Chase, and she recently moved to new quarters in what used to be the Bear Stearns office. I told her that she should follow your career all the way, but and become a college professor. On the issue of risk, I wonder if you should not distinguish the risk to the corporation, to the company, and the risk taken by the individual executive of such institutions. I fail to see the risk taken by, say, Mr. Mozillo of Countrywide, or Mr. Ford, who walked away with $400 million. I think they had no risk. And having no risk with such compensation in a short time, so who cares what happens to the corporations? Those companies may have died, but there will be others in the current environment. I wonder what you think about that. Thank you.
Thank you. And of course, your description of the building does not bring back any painful memories whatsoever. We're talking about incentives, and we're talking about how companies reward various kinds of behaviors. I would go back and venture a guess that during the past 5 years, during which these executives made the kinds of numbers that you referred to, if the financial markets saw the buildup in leverage by these companies, these executives would have gotten dramatically less, because they get compensated based on the increase in their stock prices, and these stock prices would not have increased, because even though revenues would have increased, their riskiness would have increased too. So the transparency that I keep referring to would go a long way in changing the compensation structure without even putting any explicit limits on executive compensation.
Do you want to follow up on that particular point?
Companies that report VAR.
Could you ask into the microphone?
Companies that report VAR and have been, like Goldman, why is that a relevant enough measure of risk, a public discussion of risk, and why is it, as that was climbing, why was the stock penalized, to your point?
Thank you. Look, I know the outrage, intellectually and otherwise, with valued risk, and it's surprising to me that post-1998, people have not learned what valued risk can and cannot do. Right? We know just the way this measure is computed. First of all, it's computed using very recent economic data. Right? So if you're in an environment of very low volatility for a long time, with all asset classes decoupling, it will naturally tell you that your risk is lower. Okay? Secondly, depending on the company, these companies can measure these things in 50 different ways. And certain dimensions of risk may not be measured. Exposure to certain intraday trading may not be measured. Illiquidity risk may not be measured, and so on and so forth. So there were several reasons of why these numbers did not reveal what was going on, and some of them can be addressed analytically, and some of them just require an additional kinds of disclosures. I don't just need to know what your valued risk is. I also need to know what that valued risk would have been in a particular market environment. I also need to know how much you would lose given certain kinds of scenarios. A lot of distrust in risk and risk-based regulation comes from the notion that we can't measure these things and we cannot understand these things. And I would take a different view. I think a combination of tools today, if used properly, allows us to have a very meaningful discussion on risk of pretty much any kind of portfolio and any kind of balance sheet. And we know exactly the limitations, pros and cons of different kinds of measures. So it's not a matter of one number. You need a meaningful description of the kinds of risks that any institution is taking, and that's available. As a matter of fact, the entire premise behind financial Darwinism is that despite all of these advances in financial modeling and risk management, none of this truly benefited executive decision-making, because executive decision-making used the language of accounting earnings, corporate finance, business strategy, and all of these rocket scientists were computing all the numbers, but it was never quite bridged.
Right back here, sir.
At the opening of your presentation, you discussed as one of the parts of the puzzle the Bretton Woods II system and the huge global imbalances that it created. Could you elaborate a little bit about what you see as the problem there, and then what the solution to it will be?
Well, let me just clarify that my comments were not about economic imbalances. Economic imbalances are obviously a function of at which rates these currencies were fixed and what kind of reserve accumulation this results in. And obviously it's a matter of foreign exchange policies of different countries and economic policies, and I'm not sure if any of this can be changed per se without some major kinds of events. What I was discussing was the impact of Bretton Woods II on this crisis, because essentially, as I said, these secular forces were already creating all of these pressures, and we came to 2003, where monetary policy in the U.S. started to inflate the economy. So that was the combination of secular forces and cyclical forces coinciding. But at the same time, that was the area of the most rapid growth of foreign exchange reserves of BRICS in particular. And considering that their currencies in many ways were linked to the U.S., it was natural for them to take these excess reserves and invest it back into the United States. So as all of the financial institutions were feeling these pressures and were engaging in this vicious circle where the more they lever up, the more they're compressing returns, trillions of dollars outside of the U.S. came and compressed these returns even further. And so again, truly a perfect storm of secular forces setting this up, and then simultaneously Bretton Woods II and cyclical forces amplifying it. And that's the role that has played.
Tom, do you want to add to that? Just if I can throw in one question that we haven't really touched on, but it's a big piece of the puzzle, and that's the rating agencies, and what role do they have? Do they have a place in this new paradigm that you're discussing? Will they be able to evolve?
Thank you, Heidi. I think we need to distinguish on the credit rating agency side between ratings of structured products and ratings of financial institutions. Because with financial institutions, their record has been extraordinarily poor throughout, and we know that. And that is based, and that's exactly for the same reason as the rest, because they don't have information about risks and returns either, right? And they too operate in the same language of accounting earnings and everybody, just like everybody else. So they have no knowledge that is different from the knowledge of equity analysts or investors about the risks of these institutions. So needless to say, they missed the entire build-up and leverage, and they were completely incapable of predicting what happened. With respect to structured products, and they were not alone, and again, improper incentives might have played a role, but first and foremost, they, just like everybody else, were making an assumption that housing prices in the U.S. can never go down on the countrywide level. And every single decision about how to price securities, how rate securities, etc., depended on that assumption that proved to be catastrophic. So I think it's a failure of risk management in terms of assumptions and stress testing on the structured product side, and it's their inability to transition away from languages that are not particularly meaningful when thinking about financial institutions on the other side. And both can be addressed, but that would require a significant change in the intellectual paradigm at these agencies.
Thank you. Gentleman right in the back over here.
Yes, in regards to transparency, both of you spoke of the issue of upcoming regulation. What are your thoughts on what has been, not specifically, but generally proposed by the chairs of both agriculture committees to increase transparency by moving all OTC derivatives either onto a clearinghouse or onto an exchange? And do you have any thoughts about the idea of perhaps merging the CFTC and the SEC?
I don't have a view on the second issue. And on the first one, again, the question is not about transparency on the level of holdings, right, which is what derivatives and other things are. The question is, after you net it all out, what is the residual risk that is left at the firm? That's the meaningful number. That's what I would like to know. The fact that they hold a certain amount of derivatives, but these derivatives could be mitigating risk, could be increasing risk. You just wouldn't know, right? So again, we need a different kind of questions to be asking of these firms.
I would just, I understand the appeal of an exchange versus over-the-counter, but I don't understand the issue well enough to know how that would inform the right regulatory approach. And like Leo, I don't have an opinion on the merger of the two regulators either. That's just not an area I spend a lot of time on.
Sir?
I had another regulatory-related question in terms of congressional activity, at least on the House side. They're talking about creating a financial stability regulator first. This idea of an Uber regulator is sort of maybe in some ways formalize what the Federal Reserve has been doing, using its emergency powers under 13.3, much more significant in terms of dollars at least than the EESA and the TARP. Do you think that would be a good idea to give one entity this overall financial stability regulatory, maybe capital requirement authority? And if so, what criteria should they use?
Well, I don't have a view on that particular issue, but I do feel confident that regulation must become more aware of systemic effects. Right? Regulation was designed to regulate any particular institution and ensure its creditworthiness and other features. But these kinds of systemic effects in a globalized world were never considered, and they have to do with capital requirements, they have to do with fair valuation, and they have to do with behavioral things on the part of GSEs and others. So I'm not sure if it's a centralized system or is it a conglomeration of different entities, but they have to take into account the new knowledge about how modern financial crises get wound up and get unwound, and take this into account when making regulatory decisions.
I'm a little leery of formalizing the role that the Fed has developed for itself here, thinking that the status quo probably works fine. If you were to add financial stability to the Fed already has a dual mandate of growth and price stability. Now to throw in financial stability could complicate that. It's easy to imagine the goal of financial stability undermining or working at cross purposes with the goal of price stability, for example. And I think the Fed as an institution, it's responded in an extraordinary way. To reward it with further responsibility, it may not be the best outcome here. It may be better to try to beef up other sides of the policy process to take a little bit of pressure off the Fed. That's just my first reaction when that proposal came out. I think it was part of the Treasury proposal, wasn't it, to create the Fed or set up the Fed as the financial. Had taken on responsibility for financial stability. I just wonder if that goes a little too far.
And to Tom's point, I think the Fed has been very skillful and persuasive in constantly balancing the dual mandate and taking other things like financial stability into account. So when they talk about stimulating growth, they constantly reiterate that price stability is an important objective. So keeping those two as governing objectives and giving them powers to do other things to ensure that seems to be working well, to Tom's point.
Well, I want to say thank you very, very much to both Leo and Tom for joining us here at the New America Foundation today. I think that they did an excellent job of describing a very, very difficult and complex subject and gave some real light on how to look at solutions moving forward. And I want to thank you for joining us here today and asking some excellent, excellent questions. Leo's book, Financial Darwinism, is available outside. I would highly recommend it. And again, thank you very much for joining us today.